Well, welcome guys to this morning's webinar on trading a bearish market. We're going to go through some wonderful stuff today and hopefully give you guys the heads up to going into the new year of 2008 and broadening your trading mindset into not only trading a bull market. So we've been in a bull market for basically the last 3 years. It's very easy to trade an up market when a market's going up, but when the market corrects and comes down, a lot of people just freeze in fear because they really don't know how to protect themselves. And what we're going to be going through today is some of those protection strategies. All the workings of if you were to short a stock to the downside or to buy a put to the downside as well. And different trading tactics, and then we're going to go through the sample trade. Okay. Shorting. Now, shorting provides liquidity, believe it or not, to the market, because at some points the markets go down, but when they do, fear is always stronger than greed. Stocks will always fall faster. So fear is actually a stronger emotion with traders than greed. Use an example here. This is an example, very quick example. First of all, I'm shorting a stock. And when we do this, we want to marry it with the news. And one of the news items that we can use in the market at the moment is the subprime mortgage effect that's having on the overall market. As these financial companies come out and continue to write off debts or continue to miss their earnings, there's an example here of Citigroup. When they came out and announced a $6 billion write-off due to the subprime mortgage debt, when we short a stock, we sell it at the higher price. So let's just say when Citigroup was up around at $40, we actually sell it. So what happens is your broker goes out and borrows those shares from somewhere. You don't actually own those shares, but it's called short selling. So he will sell that stock at $40 a share. If you shorted 1,000 shares, he would put $40,000 in your bank. And as that news effect takes place on Citibank and Citibank falls down to $30 a share, then you go in and buy those 1,000 shares back, replace the shares given to the broker, and keep the difference between $30 and $40. And we're going to go through some the realities or the mechanics of if this happens, what if this happens, and how do I protect myself? Because if you short a stock of $40 and the stock jumps up to $60, then it's gone in your opposite direction, hasn't it? So we're going to talk about different scenarios. We're going to talk about stop losses, which are very, very important on these different strategies. If you bought the $40 put going out on this news and you took a put for 6 months, that put is going to cost you $3.50. When the stock falls down to $30, you can sell that put, let's just say it falls a month later, you can sell that put for $11.50. Now see what's happened to your $3.50 put. As the stock's fallen from 40 to 30, your stock's gone from $3.50 to $11.50. There is automatically $10 worth of intrinsic value. The difference from 40, where you bought the put, and where it's trading at 30, that option has to be worth $10. It's worth $11.50 because we're going to talk about this, because options are made up of time premiums that you pay for. So as that option carries on, it progresses along its time frame, whatever the amount is that you paid for time is going to slowly come out of that option. So you need the intrinsic value to replace the time value. So that's options. Now options you can buy out 1 month at a time. You can go out all the way up to 6 months. That's technically called an option. What about a leap? Because you can buy a put leap. Now a put leap just means it's exactly the same as an option, but its expiry is longer than 6 months. Now it's just like a long-term call option. You buy a long-term put option. So if you think there's overall that there's bad news coming out on a particular company or a sector, and you might buy a 12-month time frame. We're going to talk about today, especially on the financial sector, that's been hit really, really heavily with the subprime mortgage market, just how we can take advantage of that and look at long-term puts, either to take advantage of the fall or to protect our portfolios. Obviously, the more time that we purchase with an option, the more it's going to cost us. But with long-term puts, because they play out over a longer period of time, they're actually less volatile than a short-term put, obviously. The short-term puts are going to move obviously a lot more rapidly because we haven't got the time with them. The long-term puts are going to move a lot slower. There's another strategy also, which is a defence strategy. It's a defence position by selling also a covered call. So if you own stock, you've got two options. One is to buy either a short-term put for the downside protection or a long-term leap for the long-term protection. Or there's another strategy. You can also sell a covered call. Now, if you sell a covered call, if your stock is, let's just say, using an example, if your stock's trading at $20 a share, you think that that stock is going to fall, then you can buy, let's say, you might not buy the $20 put, you might not sell the $20 call, you might sell, let's say, the $15 call or the $17.50 call, the next strike price in the money. So if you sell an in-the-money covered call, that's a very defensive position, strategy because you think the market's going to pull back. So remember, it's going to be made up of premium, isn't it? It's going to be made up of intrinsic and time. So that's another way of using a bearish strategy to protect your stocks. There's other strategies as well. Another one is selling a naked call. Now, selling a naked call, you don't ever want to do this. It's not advisable, and most brokers won't let you do it. If you sell something naked, it basically means you sell an option, but you don't own the stock. If it goes against you, you're having to go in and buy the stock at a very expensive price. When we sell a covered call, we like to own the stock because that is our protection. One of the risks, let's talk about two things I'm going to really focus on today. One is how to short stock and what it all means, and how to trade options, put options. The two different risk scenarios in these two different strategies. I'm going to use